Welcome to the Property Lane, where it's everything real estate. And tonight, we continue with the subject of alternative housing finance. For those of you who want to build a home, those of you who want to buy a home, and for some of us who want to build cities or build estates or put up blocks of apartments, we are asking, where do we get that capital? Must I have all the money? If I don't have the money, where do I find it? If I have some of the money, who will partner with me to top up? And last time, we were understanding concepts like a joint venture. What's a joint venture? Or a JV. In your business dealings, you've had people mention JVs, and you've heard of equity financing, risk financing. I'm sure by now you know. If you haven't, look for that link of our previous episode on alternative housing finance and get to catch up with us. Without further ado, ladies and gentlemen, our guests tonight, demystifying the mystery of capital investment in real estate. I have with me the very first guest, Mr. Chiyinji Vincent from Business Partners International. Yes, Vincent.
Thank you, Kathy. Good evening, viewers. Glad to be back again to extend our conversation. Very interesting conversation. I work for Business Partners International, and we are located at the Nakawa Business Park, Block A Level 2. You can find us there for your financial solutions.
Anyway, thank you so much, Vincent. Next, we have with us, representing the real estate sector, both developers and agents from Credo Management Limited, the director himself, Mr. Nsamba Wilberforce.
Thank you very much, Kathy.
Yeah.
Glad to be back today as I talk to bankers and business partners about a very pertinent issue in real estate development of financing. I come from Credo Management. We develop, manage, and sell properties. We are located in Bugolobi. Thank you very much.
Thank you, Wilberforce. And finally, ladies and gentlemen, our very own bank. Well, it started as our bank. I don't know if it is still.
It is your bank. It is your bank.
Yes, we have with us from Housing Finance Bank and the head of mortgages, Mr. Emanzi Jackson. Please say hi to our viewers.
Thank you, Kathy. Dear viewers, it's a pleasure to be back again today. Interesting conversations around home ownership, and we've gladly done that as Housing Finance for the last 54 years. And we look forward to giving you your next home or your first home. Thank you.
Thank you so much, Jackson. And last time, as we were concluding our show, Jackson was taking us through what you need to know to be bankable. And from statistics, I've had less than 2% qualify for a bank loan or a mortgage. Is that true, Jackson?
Is it 2%
of the entire population?
of Ugandans? No, I think the number, the qualification is much bigger. It is only that maybe banks, we hadn't thought of solutions that reach every Ugandan. The statistic I believe you're referring to is the less than 1% of Ugandans who make above a 2 million shillings threshold.
Yes.
And then the rest of us all make below the 2 million threshold. And maybe the question would be, if I am in the rest, can I still get a mortgage?
If I'm earning 300 to 500,000 a month,
can I still get a mortgage? The answer is a big yes. You can. At Housing Finance, we don't just look at you outrightly buying a piece of land or buying a house or taking on your entire project in one go. We also have a very interesting solution called an incremental housing loan, or what you've heard us call our Zimba Mpola Mpola loan, where you can approach the bank and build your house in phases, meaning you also take your loans in phases. You may have a plan to put up a 4-bedroom house, but because of your income today, you can only borrow in portions of, let's say, 10, 15 million. We welcome you. We will give you your first 15 million. whatever it can do on your house, will quantify it and finance you to put up that phase. As you pay down your 15 million, as you run it down and for your next phase, you come back to the bank, take another. So you can build your house.
Will that take me like 10 years to build a house and sleep in?
It can take you, and from experience, the customers we have served under that option, end up building their house in like 3-4 years. They simply phase out the house. Imagine you have a 4-bedroom house, and all you can afford now is borrow money to put windows and paint 1 or 2 rooms. Then you move in with your family. We welcome you and can finance you along those lines.
Thank you so much, Jackson. While still on that, I want to come back to Mr. Nsamba. You've heard of flipping. I have my nice old house in Kololo, but at the moment, because of its current status, it can't earn me the $3,000 client I'm looking for. How can one finance such a project? Right, like where we are sitting here at Fairway. For those of you who remember how Fairway used to look and how it is now, that kind of facelift, renovating and changing, breaking here and there and building it into 5-star hotel. So how do I turn that house in Kololo into a property that can earn me the money that is worth the market value? From a real estate practitioner, what have you been doing for such?
Thank you. Thank you very much, Kathy. I think we'll look at the different financing options available. We've had loans, outright loans, we've had mortgages, we've had joint venturing and business partnering. But let's look at what are the other options that could be available. For me, I think the question of financing begins with where you are at in life and what is the goal of where you need the finances. You know, that determines ultimately what strategy you use to get the financing. For example, we have business partnering, where you find a partner, you pitch your idea to a partner who brings in money, and who shares into your vision, gives you finances, and you work on the project.
Is that a joint venture?
It is like a joint venture, but outrightly, it could be a partnership where one says we take 50-50, or you do 10 apartments, I take 3, you take 7, if they buy into your idea. That is one way. We can have family contributions. I've seen it happen. Where a person has land, he talks to family members, they gather money together, they fund one project and gain through as a family. That's another way of financing real estate. We've seen grants where you write a paper, you present your case, and you win a grant, maybe by government or other private grant organizations that can give you money. But we've also seen now SACCOs and investment clubs have come up a lot, and I encourage Ugandans to join SACCOs and investment clubs.
I thought they're funding small money or little money investments like a business or something. Do they fund real estate as well, the SACCOs?
We've seen SACCOs that are doing $1 million projects. We've seen SACCOs that are putting up commercial buildings. So if you have money that cannot enable you to do the big thing alone, then join a SACCO in an investment club where you own a small portion but of a bigger organization. Then that brings me to the real estate investment trusts, the rates. That's another way.
Before you expand on that, because that's a whole big topic, I would like to hear from Business Partners International. Do you fund everybody? It sounds like you're doing bigger projects like Fairway or Royal Palms, you know. Are you funding residentials as well?
Thank you very much. Very good question. We are impact funders, financiers. So we look at aspects that are going to create jobs, that are going to improve humanity. So we not very much aligned to the residential type of funding, the mortgage way. But how we come in is through real estate developers like Credo that are going to develop apartments, let's say 9 apartments, and are going to sell that or flip that to the market. That we do. But the ones that require residential for you to be able to pay over 20 years, you would appreciate somebody who's earning a salary, as explained very well by Jackson, will be able to afford less than 100 million payable in 20 years. Because of the investment vehicle, we're unable to invest into that, but we are able to support him for, let's say, 24 months. We make sure that the payment is structured in a way that he pays a bullet after selling off the 5 or 4 apartments. He settles us, then we exit that property. I should mention that when we are taking stake, we always want to be minority shareholders, meaning that as a customer, you hold the higher stake in a property investment.
Yes.
So our lending criteria is based from $100,000 payable in Ugandan shillings up to $1 million. So you will agree with me
wait
that...
a minute. Tell us 100,000 in Ugandan shillings.
100,000 is about, give or take, 370 million, given where the rate is, so about 3.7 billion. I would sit here and say, from your angle, it's little. From his angle, it's much, because he from your side, you're looking at a bigger project. He's looking at a much smaller project. But we are looking for that type of niche, for that client who is unable to attract a traditional funder, is looking for an equity partner like Business Partners.
Okay. So what's the interest? Oh, you don't charge interest rates?
We charge interest, but you will agree that given it's an equity transaction where we come in with partners, we'll make sure this will, into the vehicle that we funded, will come in with a shareholder's loan. So a shareholder's loan typically will not attract the commercial rate interest, because we are looking at being paid at the exit. So as I explained earlier, the exit is explained to the client that we are extending $1 million, but you'll be able to pay back 1.2 million because of the time and also the appreciation of the property. You're going to get value. So we get paid at the end in such instances. We have instances that the one I explained before, where we have a tenant into a property that we have developed. We can structure that there's a bit of shareholders loan and there's a bit of a term loan extended to a JV. And that term loan is paid through the rental proceeds that are received, paid by the tenant. So end of the day, the term loan will be reduced. Then you only be left with a portion of the shareholders loan that you pay at the end of the 5 years.
Now you're confusing us. Shareholders loan, term loan. Please, could you break it down?
Thank you very much. I don't want to confuse the viewer, but just in the JV, there's a composition. You have contributed your land, we've contributed money. But the detail we can always explain to a client.
Okay.
So, but what I want to tell the viewer that the exit is explained. So the return is going to be earned depending on the structure of the project. If it's an apartment, at the end of the day, after you selling, after 18 months, we get our return. If we are constructing for commercial and there is a tenant, let's get paid during the course of the tenancy.
Thank you so much. We are taking a short break. When we return, we will be talking of, we'll be going into now the numbers. The numbers. When you say interest rate, what's the current interest rate? How is it different from yours? And then also from the real estate sector, how do we help someone who is building a commercial property? Because we haven't heard of commercial. We've been talking home loans, also rentals. Do we all need to sleep in houses we own? You know, stuff like that. Ladies and gentlemen, we will be back with the Property Lane. Welcome back to the Property Lane right here at Fairway Hotel. With me, the money bags and the person that makes your investment worthwhile. Yes, we were discussing JVs, term loan, shared loan, and stuff like that. You know, while at area, we were approached by some people that have land. People come to us and they say, I have land, prime land in Nakuru, but I don't have the money to develop it. And I cannot just put up anything in that land, even according to city council guidelines. There's a certain quality expected of a structure in a certain location. So my question to you, over to you, Jackson, is for such a person who just has land and no money, would you be able to fund them? Would you sit with them and, you know, find a way to turn that into an investment?
If the person or company approaching the bank has got a source of income that can pay what would be the needed installment for the loan, yes, we can.
But
So
you
the
have
most-
a down payment, right?
We do have a down payment, and when do we require a down payment? We look at the percentage of the project that we are financing. We usually would want to finance in the region of 70% of the project value.
Okay.
Now, depending on your purpose, are you building to live in, or building to sell, or building as an investment? That percentage can either be incorporated, can be either 70% of total project value, which total project value may include value of land plus development, or it may be 70% of value of developments, depending on the purpose that you're coming, you actually, depending on the purpose why you're putting up that structure. Of course, if it's a non-income generating venture, then we require a little more stake from you. So, and non-income generating in the sense that if it's more longer term for you, then we require you to have a bigger stake. I'm putting up apartments for rent, then I'll finance you 70% of the value of the works. I am putting up,
Meaning my land then would contribute the other percentage?
no, meaning 70% of the value of the works, which is 70% of the value of the bills of quantity. If I am putting up the block for sale, then it means immediately I'm going to start selling, and the proceeds of the sale, the bank can structure the loan in a way that you also commit a portion of the sales to reduce the loan. So we can get a little bit more flexible with that option, and maybe say we can finance 70% of the project value, where then now the stake of your land can play a part in terms of what would be expected as an equity contribution from you. But there may also be other alternative ways. You may as well, let me say it in a language that Wilberforce may understand, you may over-collateralize the loan, meaning you give the bank additional security. Over and above the land where you're building, you can add additional security if you needed more financing than what actually our structures can afford, just to make sure that the loan the bank is giving you is covered.
You know, in other countries, people have actually earned mostly from credit. Most businesses, or you're going to drive a car on credit, you're going to live on credit, shop on credit. Out of Uganda, it's so easy. Why is it so hard here? And that's why you'll find that I may not willingly give you my title, because there's a rumor or a belief that once you give your title to the bank, it's not coming back. Yeah? Wilberforce.
I think I believe in borrowing for construction. I believe it's a sustainable way if you have your books right, your calculations right, your feasibility right. Especially if you're constructing to sell or rent, the rent income you generate from the property can be able to pay back the financing that you got. So if you did your feasibility right, you got your location right, you got your market right, you need to get that financing. I advise that get the most affordable financing for the product that you want to put on market.
Do you have affordable financing?
I'll give you an example. Affordability then becomes on the need, the reason why you're constructing. Like I said, affordability, I'll give you an example. There are hard loans, quick loans, so quick loans of 6 months. If you've got a tenant or an interested person in taking your property for 5 years, they are willing to pay $10,000 a year for 5 years, but you need to construct this project in about 3 months, and yet the bank will take a longer processing time, you can go for a hard loan. It has higher interest, but you're sure that immediately you finish this project in 3 months, you already have off-take for paying for 5 years. There's no reason. So what I'm saying, if you have a reason, if you get the numbers right and you understand the market you're operating in, you can get financing that's just affordable to meet your project need, and you'll be okay.
Thank you so much. About that, you are talking about from both Wilberforce and Jackson, I realize one must come when they are ready. They must use a professional. But now from Business Partners International, I am a member of the Kwagalana Club, for instance. I may not know about the professionals and feasibility studies that Wilberforce is talking about. How do you prepare me to put up an investment? I have money, but I don't know about those other professional stages needed. How do you prepare me to put up an investment that can be worth, first of all, you funding me, but also that can transform the real estate sector and provide additional housing units? You know, we are at a deficit of 2.4, both commercial and residential, but for business purposes. As I've learned, you don't deal with one home loan or a house for me to live in that's too small for you. But how do you prepare me to turn this piece of property and the money I have into a big real estate venture?
Thank you. It's a very good question. One is we work with you along the journey. So for us, affordability is critical. As Credo said, the assessment of whether the project is viable, end of the day, it's going to make profit for you, and it's also going to be able to pay the cost of capital that you've acquired. So along the way, the first thing we do is to make sure, how many apartments do you want to put up? I want to put up 9. What is the expected selling price? Each apartment, it will be, yes, I'll get $1.2 million. I'm looking for 500,000. So from the onset, you can see that there is a bit of margin that somebody will make with such a project. So we look at that. But along the way, after understanding affordability, we have what we call technical assistance program, which is a non-interest bearing loan that is extended to an SME, typically for real estate, for example. Along the way, we know that you're going to build a project, but you don't know how to market it. So this is money that is not for construction, it's not for buying chairs, but it's money that goes into other aspects of a business. For example, fire and safety. You need to have fire and safety, or you need to develop a plan for marketing. We shall give you that money to develop a plan. You need to develop a website to make sure that you put up this apartment after constructing it on this project, so that it attracts the right buyers. So in that way, we are enabling the entrepreneur. Feasibility, if it is required, we do that. But this money is for, I'll call it soft challenges, not for buying all these things. So we hire a consultant for that case who will go and do a feasibility around Kololo. What is the going price for an apartment this size? So that we know, end of the day, as we partner, we enable you to get an off-take. Okay, that's what we do.
So you don't just throw me out,
Absolutely.
But you say, let's sit down and make the calculations and work this out. Yes, before we come to the end of the show, you're talking of affordability. What do you mean in terms of numbers, Wilberforce? When you say this financing is affordable, in 1 minute, what do you mean?
What I mean is financing that doesn't eat more than 10% of your project input. The interest bit does not eat more than 10% of your project input.
Jackson, what's the interest rate,
language.
the current interest rate?
Interest rate varies from
real estate.
for real estate. It varies from type of customer, type of business, profile of the borrower, and purpose. It is not one. It's not a one-size-fits-all. Why? Because we do appreciate the diversity in terms of our customer profiles. So Wilberforce may get a different rate from Mr. Chiinji if they all approach the bank for the same reason, by virtue of their profiles. But what I can say is largely you will find that mortgage financing will come at a much cheaper interest rate compared to your traditional loans and other financing products. And also in terms of structure, mortgage financing will give you a longer repayment period. And because of just those two, then it addresses your question of affordability. Because we can stretch out the loan for a maximum term of up to 25 years, for example, and you're getting an interest rate much lower than what other loan products are offering, it means now affordability is the installment you'll be paying on a mortgage. It does not take away a lot of your cash flow to impact your general livelihood as a person.
Thank you so much, our guest tonight. It's been a very engaging, insightful, informative, and educative show. We hope to learn more and more. There will be other episodes coming up on, this is not the last, on alternative housing finance. Next, when we come back, we will get into the actual details, go on the ground and meet people and talk to them and see where you fit in. From Catherine, your host tonight, and from the rest of the crew, right here at Fairway Hotel,